Well, good evening, all. Ira Epstein with your financial market wrap-up. And this wrap-up is for the evening of Wednesday, the 27th of December, 2023, just after 5:50 p.m. Central Time. I thank you for watching. What a time frame this has been. You know, I was thinking back on the two stock reports that I did. If you'll recall, I did one late September, and I laid out in that very specifically what I thought October would do, November would do, December, and into the Santa Claus rally. I would give myself 5 gold stars. I labeled it. I nailed it. All right. So if that helped you, terrific. I just did one of those reports in the dollar index as of tomorrow, Thursday, 2 weeks ago, Thursday. It was bearish on the dollar, telling you where I thought the market might head, gave you the seasonals and everything else. Tell me that market hasn't been doing that as well. So it's been a good time. Have I been telling my traders that are my subscribers to trade light right now? Absolutely. Do I think I'm wrong? I do not. Why? Because when you get into light volume at the end of the year, my experience has been, and I've done this since 1969, I've been involved in the futures. I was a runner on the floor of the exchange back then, and all the way through trading in the pits, running trade desks, owning brokerage firms. So I've had my good share of things. You get into trouble when you try to make things up at the very end when you shouldn't be doing it. You come back to these markets Tuesday morning, and you start really coming back to the market. You're picking your spots, you're coming back in. You're going to get a slew of information next week. We're already talking, what is the jobs report? The early numbers, 170,000. And what if I tell you for the first quarter, they're looking for an average of only 80,000 jobs a month? I think that's very light. But what they're saying is that if you looked at today's Richmond Fed data, and you've looked at the Empire State, Dallas, and so on, you have seen a very weak manufacturing sector. And continually we get the analysts that say yes, and that's going to drag. Countering it, proving those people wrong so far, and they've been wrong big time, has been that the service sector has held up. Now, what they're counting on, the analysts that say you're going to drop down, is that a lot of jobs are going to be let go as Christmas is over. A lot of the servicing of the holidays are over. People will gear down. I get that. They're right on that. But if you looked at the durable goods orders recently and some of the others, that flies in the face of all this. You've had very good demand. If you look at the price of copper, it's called Dr. Copper for a reason. It has been strong, not weak. So I can flip coins here. For every bull reason one analyst is giving, I can give you a bearish one on the other side. What nobody can argue is this market has been nonstop since November. It hasn't looked back. You had the very weak October reading, which you typically get, and then you had the strong period in November. You came up in December. It didn't even consolidate much. It's just been a run to the upside. Nothing grows to the sky. So be very careful here. You're getting to the point where I would expect to see anytime now some profit taking come into the market, all right? And it's probably there already. You're probably getting rotation coming out of one thing. Remember, this is where you do your tax loss selling. That's what you do. You dump your junk and you buy better things because you're getting the write-off against some of the gains you may have taken during the year. If you look at the S&P, it has been crawling higher and higher. It is not a pattern that has been a running pattern. This was a much more bullish pattern. You had higher lows, higher highs. Here you've got a lower low. This is called a swing line. And on a swing line, by the way, you take the line and you look at the day before. Did you make a higher high, a lower low? Did it have an inside day? Or was it an outside day up or an outside day down? There's 5 rules. I teach them in my full charting course. You put it on and you can look at a chart and say, oh, it's not trending, but what's the bias? Certainly to the upside. What determines bias from my point of view? When the market is over the 18-day average of closes, the bias is up. When it's under it, the bias is down. It is a filter of swing lines. It is a filter also of momentum. you can see that number one, the bias is up and momentum is locked in. This is called an embedded slow stochastic reading. It's when the two numbers that make up slow stochastics, they're called a K and a D line, the red and the blue, are going sideways over 80 for a certain amount of days or more, which it is, and it locks in. When that locks in, it takes over leadership on the chart. The chart isn't as important as the momentum. And in this case, until the red line closes under 79, the trade is buying the breaks in the market, looking for higher highs, ideally up to, on this chart, what we call right here, the black line is the Bollinger Band. Now, I also use something called a window envelope, but not the standard deviation you're used to. I tie them together with where in the range of market closes, along with where's the swing line. So it's different. The concept is the same, but it's much more attuned to the market rather than using a fixed percentage. Oh, if the market gets up this percentage, it's into an area it normally stops. I developed it many years ago. I love it. I think it's way better than the standard way. By the way, in my charts, in my subscriber video, I only use 5 indicators. So each one is built to either reinforce or filter out a trade. The purpose is not to trade. I know you think that's crazy, but it's true. And once everything's screaming, do it, do it. It's that simple. Higher lows, higher highs in the NASDAQ, embedded reading, bullish as can be still. What about in the Dow? Again, like the S&P, a lower low, higher high, but you don't fight this. This has been embedded since mid-November, early November. It has kept the trend of the market just going to the higher point. And when you've gotten up to these Bollinger Band areas, you've set back away from them, and the market continues. Eventually, it won't continue. You play on that. So you're not buying more as you're going up. You're, at the beginning, adding on to your trades, but when you get up to a certain level, you start peeling parts off, and you hold until the trade is no good anymore. When you come to the Russell 2000, fully embedded reading, and I know traders are saying, I got to own that Russell now because the rotation's there. Maybe. It has certainly not worked that way for 2023. Maybe it'll work in 2024. We all don't know. Trying to predict in December what's going to happen next year, it's fool's play. It's wonderful for the novices, the young interns joining brokerage companies. You put out your pieces. I give you an idea, or the big guy that's been there, the head dog of the company. Well, this is basis what I'm seeing, but I want the right to reserve to change it because the fundamentals will change along the way. That's how they talk. In 10-year note, as long as you're embedded, you're looking for lower rates, and you're getting them. The higher futures go, the lower the real rate goes. You lost 10 basis points today. In other words, you're back into the 383 level. Weren't they just saying, all the big boys, in November, we're going to 6% interest rates? Nobody got it right. Wasn't this the year, if you go back to the beginning of the year, that we were going to be in recessions, things weren't going to be good for 2023? Who thought these type of gains? Trying to predict these markets in December for the next year, whatever that year is, fool's play. In the dollar index, back down, this is a profit-taking area, and I just put out a bearish report. You're just getting back into where the pros are going to take some money off the table. Money off the table is not getting out of the positions. You put on multiple contracts, you take some off, and you ride. Market comes back to you in your way. Especially if you embed, you're going to get more aggressive and sell more at that point. In the eurocurrency, right up to the upper Bollinger Band today, if you were my client, you were sitting next to me, you'd get an elbow into the ribs. Why aren't you coming out of some longs or all your longs, whatever your strategy is up there? You're not going to stay over that Bollinger Band more than 5% of the time. That's the theory, and that's how you look at these things. British pound, the same identical thing. How many times have we heard the demise of the pound? They're all in trouble. What's really going on is the race is beginning. Who is the first to weaken their currency via cutting rates? Who is the first that will, by cutting rates, the market will say, this will spur their economy up and kick it on, and it'll make their currency actually stronger. It's a two-way thinking in the market. The dollar will be treated different than a number of the weaker currencies. Remember that. You got to put it together. Then we get to Bitcoin. What have I been telling you since over here? I said, Bitcoin is something, back here is when I said it, you have to buy it, you have to own it through December because you don't know when the SEC will approve the ETF. But barring everything I've seen, they have to approve it by January 10th. When they do it, money should flow into it, but it won't wait for that. It'll anticipate the money. Well, it's done that. It's gone from the 38,000 level, and here you are sitting at 44,195. You could be at 50 before this thing finishes itself up. Now we have to move over to the Brent versus WTI crude, and the higher it goes, it simply means that Brent's leading the way in price to the upside. Now, you know, the Biden administration is jumping up and down because they bought 3 million barrels of oil for the strategic reserves. I applaud them. They finally did it, okay? I don't mean that in a negative or facetious way. They should be buying all the way through. It's called a strategic reserve for a reason. Now, do we have to get back to 500 million barrels? I don't know. But you did sell 180 million, and you've only, altogether, with the swaps you're going to complete by February, you've only got 14 million back. I think you got a ways to go, period. I'm looking for resistance now right up here. The Bollinger Band. Why would I be thinking the market's going to stay over it on this move? Here, look at the 200-day average. What is a 200-day average? For all purposes, it's as close on a long-term average as you can get to a one-year average. There's 250 to 260 business days in a given year. That includes standard holidays. It varies depending on the year when everything falls out. When you get to a 200-day average, it's a powerful average. It's telling you for most of the year, this is what you're fighting against. The combination with a Bollinger Band, where that algorithm, you're only over at 5% of the time, pretty powerful, and you're overbought. I think the pros are stepping away from the market right here. When you come to the heating oil, are you looking outside? Unless you're in the Dakotas or one of those cold areas, for the big swath of the Midwest, right on east, it has been one of the mildest on record Decembers in recent times. I mean, I think in Chicago it's going to be the 7th warmest of them. We are averaging like 45 degrees when we should be 30. I mean, it's just beautiful. I'm watching every day, I swear to you. People are jogging. They're in shorts and running jackets. Unbelievable what I'm seeing out there, and no snow whatsoever. And in nat gas, well, the market's gotten back up to the 18-day average. So when you lose an embedded reading, I'm developing a technique with AI to come up with a service that shows you how to take advantage when you lose this to try to get back to a neutral point on a chart. But that's more later this year. I want to remind you, if you'd like to get a lot of the gear that we offer for free, it's a combination of courses that we have and so on, go to our website at iraepstein.com, and on the top left, free offers. They'll look like this. You come up, when you hit the free offers, you'll see a blue box pop up. You click it, it just lets you in there. And you choose which ones you want. And on the bottom of the page, you put your name, your email address, and we'll get everything mailed out to you. Can it be simpler than that? It'll all come via email, and away you go. And there's many free offerings. Advisories, price count studies. I don't know if you've ever used those. I don't know if you know how to use some of the different pivot point series, the Arun indicator. We've got them all. How do you get this? Move your cursor to the top. One way, you'll see an icon. Second, iraepstein.com. And you go where? Top left of the website, free offers. Give it all a click. I'm Ira. You have a good day.